Well, I think it's telling us that we're going into a world of much lower inflation in the short term. But in the long term, we're probably going into a world of higher inflation. This year, the key workers are going to ask for a pay rise, and they're going to get it. They deserve it. Also, bond yields can't stay at these levels forever. They can stay for a period of time, but not forever. But the short-term reaction to a market shock, a demand shock like this, is lower consumption of commodities. We're seeing stress across the sector. Real economic recovery is going to take some time. It's going to be the back end of this year. And so there's inflation, and deflation is not good for asset prices.
Charlie, very good to hear from you. Good to see you safe and well, my friend. Look, in terms of what happens next, and I know I'm going further down the line here, it's obvious there is massive destruction of demand now for the foreseeable future, but there's also massive destruction of supply as well. Not many banks are going to look very excitedly about new shale wells going forward into the next few months or so. With the supply destruction, do we create a situation where we are going to see sharp and aggressive moves to the upside, albeit we don't know the timescale?
I doubt it this time because there's just so much excess capacity in the system. It's quite a long time to flush out, literally, the overhang of inventory. Recessions going back 100 years, they've always been about excess inventory. We always thought in the modern world we've solved that problem with computers online, artificial intelligence, and so on, just-in-time manufacturing. But, the system is clogged up, so it's just like an old-fashioned recession in that sense. It will take some time to destock all of these things. And we don't just look to oil, we look beyond oil. And I would say the action in copper yesterday was telling. That could be on the way to making new lows. But, I'd sooner be a buyer of a copper stock than an oil stock because this is easier to store excess inventory.
Charlie, I'll just pursue the point one more time if I can, and then bow to you. But a lot of the investment in energy, and this is something that people seem to forget, isn't about new energy. It's not about increasing supply. It's about maintaining current supply. Now, admittedly, the 100 million barrels a day demand picture has been shot to pieces, but we think it will come back over the medium term. We're still going to see population growth. We're still eventually going to see economic growth in emerging markets, which were the X factors on the upside. Even if it's just about maintaining supply, if that investment isn't going in, then that creates a problem, doesn't it, for mid to long-term suppliers?
Well, absolutely. And I think that one of the big problems post-2014 is the fact that investment in the sector has been falling consistently. And I think we've been complacent, and also the fact that a lot of US shares in particular is backed by cheap credit. So if cheap credit was to go away in the longer term, then that would also be a problem. And I think if you get to this sort of 1970s type 10-year view of recession that starts with prices and ends with freezing commodity and harder to access credit, then absolutely we are going to have higher oil prices in the future. So, clever people buy right now, but where do you put it? And all the tankers are full, so that's the issue.